Part 3 of this week 9 lecture, our final part, is going to deal with accounts receivable and what happens if someone doesn't end up paying you. And the final part will be on interest and how to calculate interest that you are due but haven't collected yet. So our first part here, account receivable, we have to record what's called a bad debt expense for any revenues that we no longer are able to collect. So when we have in our using GAAP accounting, we record revenue when it occurs, not necessarily when paid. Just because I have an account receivable on someone doesn't mean that they're actually going to pay me. Some people will not pay for various reasons. So if we've already recorded the revenue, and if that money never will come in, we have to then, in a sense, kind of write it off. And we write off that revenue with an account called a bad debt expense. It's a different type of an expense. We didn't really get the benefit of anything, but what it's really doing is, in a sense, lowering our revenue account by bringing our net income down, because that's money that we never really will get. So there are two ways to figure out how our customers aren't going to pay us, and or actually two ways of how we're going to show it on our books. The first way is really more for cash-based taxpayers. These are the taxpayers that only record revenue, like for tax purposes, when they get the money. If somebody doesn't pay them, basically if you would look at their books, it would not show revenue for that client. Therefore, if they don't end up paying, there's nothing to take back off because they never did show the revenue up front. So in those type of items, what they're going to have is the direct write-off method, where they actually go right into the account receivable. And so the account receivable isn't overly inflated, because we don't want to keep somebody's account that's 10 years old and still showing due as an account receivable, because that's not realistic. If I'm ever going to show my books to a bank or somebody for a loan, I'm basically presenting on there that I'm due money, and I actually think I'm going to be getting this money, when in reality it's not going to happen. So if you're on the cash basis, you basically do the direct write-off method, where you pick a time, say after 6 months. If the person hasn't paid me within 6 months, I'm going to automatically go in and take it off my books, and then send it maybe off to the collection agency or whatever you want to do at that point. And when we take it off our books, and in this case, we will simply just do a bad debt expense and credit our client's AR account. Now, whereas if we do it the GAAP method says we don't want to wait 6 months or a year or whatever it is we pick to actually write it off of our books. I want to be able to estimate right now how much I think will come in. Even though I don't know exactly who isn't going to pay me, I can get a pretty good estimate based on prior records. So that's called the allowance method, is where we take an estimate, and we have an idea of how much won't be coming in, but we just have no idea exactly who it is. If we knew who it was, we wouldn't have sold to them anyway. But since we don't know, we're going to make an educated guess. Kind of like depreciation. With depreciation, we make an educated guess that we're going to use a piece of equipment for like 5 years. So when we make this educated guess, we're going to create a contra AR account. It's just like a equipment account, accumulated depreciation. The two go together. Just like equipment and accumulated depreciation can go together, and we can, in the end, net those two numbers together. You can kind of do the same thing for the allowance for doubtful accounts. We can see our AR says we have $10,000 coming in. I'm just making up a number. But our allowance for doubtful accounts says, well, out of that $10,000, it's my best guess that $750 probably will never come to fruition. We'll never actually get it. And so I would have a contra account to that $10,000 that says $750. And then if you were to net those two, you would say, okay, in total, I expect to only get really $9,250 when you subtract out the $750 of the allowance. And that $9,250 the term there is called the net realization value. How much do I really expect to get net? That's why they call it the net realization value, 92.50. The method we're going to use to do our estimate is called the aging of accounts receivable method. The aging of accounts receivable method. When we do this, what we're going to do, as you can see in my example over here, is companies will separate out of their AR. They'll take every piece of their AR, all 40,000, and separate it out into columns, into rows. And they may go further. I just stopped at 61 days, but they could go all the way down as far as they want. And they're going to say, and then they're going to provide this estimate. This is kind of like an estimate for our depreciation purposes. If we say 5 years, it's an estimate. I don't know exactly how long. Just like this, out of the 25,000 that is currently not late at all, some of that will eventually filter down, and that's, I mean, at one point this 8,000 was not late, but it had filtered down over time to get down here, so it is pretty late. So my best guess is that maybe 2% of this 25,000 is going to be at some point become uncollectible. And then I have to estimate all the rest of these, 5, 20, and 50, and say these are my best guess of what will be uncollectible for those amounts due. When I go over here then and calculate the actual dollar amounts as part of my answer, so just for an example, when I do this 25,000 at 2%, that comes out to be $500. And I'm going to do that for all the remaining rows and then add them up. And when I add them up, that new total is actually the new total for my allowance for doubtful accounts. It's not a journal entry amount. I then have to do the math to figure out what the journal entry is. So I know what my beginning amount is because I've given it to us, 3,000. I'm going to go through and total up all of these, get one final total. Say it was $4,000. Well, my journal entry would then be, I went from 3,000, now I'm at 4,000. What did I do to get there? And well, I would have had to have credited $1,000 because remember, this is a contra account. So if it has a 3,000 balance, it's going to be a minus plus. So it's a plus on the credit side. And if my new balance is 4,000, that means I added 1,000 to get there. So let's look at how this example actually does work out. So here's part of my answer now. I've got the 500 that I said. And then when you calculate all the rest of these, so like 8,000, 50% of that is 4,000. If you add all these up, this becomes what my new allowance for doubtful accounts should be, $51.50. I started with 3,000. So if I would do a T account, if you could kind of, I know it's a very rough T account, it's not very easy to do in a Word document, where in Excel it's a lot easier. But if I had 40,000 over here in my AR, and then I got my contra account, minus plus, if I started with 3, and I knew I had $51.50 to get to at my ending point, what is my journal entry to get me to that point? And hopefully you can see that it would be $21.50. That's $21.50 new dollars that I expect to never be seen again. And if I don't see those dollars, that's where I use my bad debt expense. I want to remove it and treat it as a reduction of my income as an expense does. So I'm going to debit my bad debt expense for the $21.50. And then, as I showed here, I'm going to credit my allowance for doubtful accounts to get it up to where it needs to be, of $51.50. Now, part 2 of this one, I then tell us, after we've done all this work, 15 days later, we get a letter in the mail from Marty's attorney that says Marty's bankrupt and the $800 that you expect to collect will not come in. Well, what I had just figured up here, this $51.50, the allowance for doubtful accounts is kind of just a real fancy name for an unknown I know people aren't going to pay me $51.50 out of the $40,000. I just don't know who isn't going to pay me the $51.50 total. Now I know where some of that is going to be coming from. I know of the $51.50, I can take back out, I can subtract as a negative, if you put it over here, $800 will not be coming from my client Marty. So if I put 800 over here, that brings my unknown now down. A little bit less now is unknown because I know exactly Marty's AR account is going to be reduced as a minus for that $800. So really what happened with just this transaction, it didn't affect my net realization value at all. Because right here at this point, I had a net realization of just under $35,000. So you would have, if you would have done it out, if you combine these two, it'd be $34,850. And then if I would have taken 800 here, taken 800 here, get two new totals, and then combine them, it would still be the same $34,850. Because all this did is just moved two numbers from the same family of accounts, just switching them around. Okay, the last thing we're going to look at is a note receivable. A note receivable is very similar to an accounts receivable. However, a note receivable typically will have interest, and it will also usually be more in-depth. It usually have signatures, time, exactly when payments are due, but the key thing is it usually does have interest. Whereas an account receivable will just say your total due is due in 60 days or 30 days, and you just pay it when you can over that time, and as long as you do it within that our specified time frame, no interest. Well, sometimes you can't pay it off in that short amount of time, so they'll say, okay, we'll start charging you interest, but you can pay it off now over 6 months or a year. And to know how to do interest, we got to think back to our math classes, and it's a pretty easy formula. Interest equals principal times rate times time. And time is always dealt with in years because our interest rates are always in years as well. Whenever we get an interest rate, unless it specifically says otherwise, an interest rate is always told in terms of a yearly rate. So you'll see like a 16% APR, which stands for annual percentage rate. Therefore, if it's a 16% annual rate, but I only have the loan for 6 months, I'm not really paying full 16%. I'm only paying half of that because it was only half a year. So that's why our time is always in years, because it's got to correspond with what the rate is. Now, if we do allow somebody to have a loan from our company instead of paying us up front, we maybe do a service for them and then allow them to pay over a long period of time. A great example would be like a roofing company, and we'll do that example. That would be a customer that probably can't pay in just a month or two. It's kind of hard to come up with. It's kind of hard to come up with $10,000 on the spur of the moment. Therefore, we need to maybe create a payment plan that has interest, and that's what we're going to be doing here. Well, even if we don't get paid the interest by the end of the year, just like what we do with wages, when we owe our employees work but we haven't paid them yet, we create a wages payable. Just basically in the same concept, if interest has been earned, we've got to show it. Even though we haven't been paid the interest, we're going to show that we are due this interest. So let's look at my example here. On 4-1 this year, we completed a roofing job for $10,000. And the customer, we have agreed that he'll pay us in one lump sum a year from now. And we do charge a 10% interest rate. So our answers here at this point, what we would do is we would say, okay, what did we get? We got a note receivable from whoever my customer was for $10,000. And then I asked the question, why did I get the note? Well, I did a sale. I did my job. Maybe I can call this a service revenue if I'm actually putting on a roof for $10,000. Now, what I have to do then, and what makes this one kind of new, is I need to do an adjusting entry. Just like with my wages, when employees have worked, I need to show that the work was done and that I owe them money. Just the same here, except it's kind of reversed. I'm now due money. I have earned it. I have loaned them the money for that $10,000 by doing a service. I just haven't gotten it yet. So I am due. If they were to pay me right now, they would owe me interest. And so I call that what it is, an interest receivable. And then out here to the side, let's do the equation. Principal times my rate, 10%, times my time. And so what I need to do is calculate how much time has elapsed since either A, the most recent interest calculation, or B, if there has been no interest calculation, when was the loan originally made. So there has been no interest calculation so far. So the loan was made back in April. So we need to count up exactly how many months have gone by. And if you count them all out, April through December, that's 9 out of the total 12 months. So 3/4 of a year is basically what I'm saying here. So 10,000 times 10%, that's 1,000. 1,000 times 75% is $750 of interest that I have earned. And then you say, okay, well, I've earned it, so that is considered interest revenue. So I'm due the money. I haven't been paid yet. That's what I got. I got it because I have earned the money over the last 9 months. Now, as of 3/31, I'm actually going to get paid. So I asked the question, what did I get? I got cash. And then kind of the same as I do with the sales revenue, off to the side, somewhere over here, and I'll do it down below. I want to figure out, where's my cash coming from? Well, I know part of my cash is coming from my note. Part of it is coming from last year's interest that was already recorded. And part of it's coming from this year's interest. So now I can just start adding up the totals to figure out how much I should be receiving. The note was $10,000. Last year's interest was $750. This year's interest, well, I can do my calculation again if I don't know what it is. So I take the 10,000 times my rate, 10%, times my time. Now remember, time is whenever your last interest calculation was, or if there weren't any, the beginning of the loan. Well, I did have a prior interest calculation. It was back up here at the end of December. So starting January 1, there's been 3 months that have gone by that I have earned more interest. So 25%, that 10,000 times 10% is 1,000, times 25% is $250. So in total, I expect to collect $11,000. So that would be my total here. Now I can finish out my journal entry. I expect to get $11,000, and now as credits, I just need to show where did that $11,000 come from. It came mostly from my note receivable. Part of it came from interest that was due to me last year, interest receivable, that I already calculated up here. So now I'm just getting it out by showing that it's been paid. And the remainder, this year's interest that I have earned. And if I've earned it, it's called interest revenue of $250. Now my total credits do equal my debits. All right, that sums up this entire week. We've had 3 different sections. Now you'll want to go in and try to do the Wiley Plus, and I do have some examples of videos on the exercises 8-5, 8-7, and 8-10. We'll be back next week for our last week before our second exam dealing with depreciation and gain or losses.